How does a broke single mom that was fired from Denny's go on to become one of the top podcasts in the entire world? I don't know, but that's how it happened with me. So welcome to the most wonderful real estate podcast ever. Our motto in 26 is we're going to stack gold bricks in 26. Big bricks, big wins, all kinds, even little bricks. Every little thing counts, even tiny little gold. We're going to focus on building gold mines. You do not want to miss a single podcast I have coming to you in season 8 of the most wonderful real estate podcast ever. We're going to learn how to stack bricks in 26. So register, follow, don't miss a single podcast. They're all going to be great. And if you haven't started investing yet, this is your year. Don't let any more time pass. It's time for you to be a successful real estate investor, and that's going to happen for you with my help. So welcome to the most wonderful real estate podcast ever, Season 8, 2026. Hey, everybody. Welcome to the most wonderful real estate podcast ever. I am so excited because it is Season 8. Can you believe it? I am in my 8th year of podcasting. It's 2026. I'm 8 years in. I have almost 2 million downloads thanks to all of you. I have 686,025. So thank you. I appreciate you listening. I appreciate all the 5-star reviews, all the subscriptions. I love my audience. So Mr. Jay is my very first guest for Season 8. So we're so excited to have Jay in the house today. So this is the fresh start of my 8th season, and I have met some of the greatest people and interviewed people and worked with people, and it's just been amazing. So congratulations on being guest number 1.
Woohoo! Thank you so much. I appreciate the honor of being your first guest this year.
That's it.
Exciting.
So Jay, we just throw people to the wolves over here. I just have you really quickly tell us who you are, how to find you on social media. You give me 1 or 2 lines about what you do, and then I'm going to ask some questions.
Sure. Well, first of all, like you said, my name is Jay Patel. Been in real estate over 25, almost closing in on 30 years. We're getting old, man. I can't believe it, how fast time flies. I currently manage the Proptex funds, and more specifically, we've created a fund called the Proptex Income Advantage Fund 1. And that's our flagship fund, if you will. It provides a nice 11% consistent yearly return. And as far as what I do is anything and everything to do with real estate. So like I said, I've been in it for a long time. Currently also hold a managing broker license, although I don't really practice it. I really have it more for, the ability to have access to the MLS and be able to find all the information that I need in terms of, doing our research online, at least in the local markets. And and so we do. As far as finding me online, you can go to our website, Proptex. That's PROPTEX.com. You can also check out our LinkedIn profile, or my personal LinkedIn profile would be under LinkedIn, Jay Patel. And then there's a dash MLS. And you say, why is that there? Well, because besides just doing regular investing in real estate and now managing this fund, I've also been involved in the prop tech space. So you might not know this, Dwan, but 90% of the world does not have an MLS system in terms of all these countries. We developed the first MLS. You do know, that's fantastic. So we developed India's first MLS system. My nationality is Indian as well.
Really?
So I happened to go there and saw that the market was a complete mess. Absolutely. So we built that. We started that project back in 2015. We've grown it to over 12,000 users. Now we're expanding it internationally. Of course, 12,000 users is nothing in the grand scheme of things. Our goal is to get up to, a few 100,000 users now. Then now that the product is built, we're going to really blow it open and do a significant amount in advertising and marketing of that. And then we're also expanding Southeast Asia globally. So we're looking at Philippines and a few other countries. That will be our first forays in 2026. But so that's why my LinkedIn has that dash MLS. If you go to Instagram, you can find me at Proptex Funds. That's our LinkedIn, our Instagram profile. And that's a bit about me.
So after I interview people, then I Instagram stalk them. I go follow and then I read and read and read and read and
Follow us.
read. No, I definitely am. And
It's a new profile. If you go on it, it's a new Instagram profile, so you won't see a lot on there, but you see some videos of some past podcasts we've done. But this is where you got to start. So Proptex Fund
yep,
is actually a relatively new fund, even though I've been in the business over 30 years, almost 30
yep.
years now. I've been doing it for myself as well as individual clients. But to actually set up a fund is something that's relatively new.
Oh, it is. So I just want to go back to what you said. So you are in PropTech. So prop TEXT, PropTech.
Proptex. So it's prop short for property, PROP, then T, and then EX. So basically, we came up with the word. Nowadays, if you want to get by the way, I commend you because you've got a fantastic show and you came up with your own name, Dwanderful. It's
I did.
fantastic because you took your first name. So we had to do something similar. There's really, nowadays, getting a .com is almost impossible,
It's
right? Like if
so
you want to
hard
get
to
a one-word
do.
short .com,
It is.
it's impossible.
When
So
I
what do
first
you,
start,
and
when
what do
I
you have to do? You got to create.
You got to create. When I first started my podcast, I had a few people that were in the podcast and they said, you should do a play on your name. I was like, a play on my name. And I thought, okay, Dwan. And I was already calling people like my Dwandonaires, my millionaires. And I would always say, have a Dwantastic day. So I was kind of already using my name. And I thought, like wonderful, Dwanderful, like Mr. Wonderful. I thought, oh, that'd be fun. I'll be Dwanderful. So
I
I
like it.
officially made it official. But yeah, it is hard to get names for anything these days. It
So
really
how we came up with PropTex is prop short for property. T is for technology because we combine technology with property, especially now using AI. And then X is basically our expertise. So we came up with the word PropTex, and that's what we have, proptex.com. So you can go to the website there and get some
Oh,
information.
TEX or TEXT?
No, just TEX.
Okay, I just want to make
PropTex.
sure because I
Yeah,
thought you said X. So PROPTEX.
correct.
We need to know because
Correct.
I thought you said text. So I love it. So I just want to ask you. So you said, so I know that in other countries, I actually work with a lot of people in the Philippines and India and people in Canada and around the world. The MLS is not available to everyone. So you have created a system to make the MLS available in other countries.
Yeah, not our MLS. Our MLS is here locally, right? It's so MLS basically, as you know from your vast experience, is that it's a software tool that aggregates all the property listings in a local, like a geographic market. So, for
Mhm.
example, if you're in South Florida, you'll have an MLS there that has all the properties in, say, Palm Beach County and then
Right.
Fort Lauderdale. So I guess that's Broward County, and that all comes into one plat. So I'm in Chicago, and in Chicago we have a system called MRED, MRED, Midwest Real Estate Data. And that aggregates all of the property listings in the greater Chicagoland area. So there's only one MLS in every geographic location. And sometimes in some markets, for example, in California, you may have two or three, like some of the brokers may have to get two or three different MLSs only because, the cities are there. You've got bigger cities that are pretty close nearby and they have
Right.
two different MLSs. So if you happen to be in the middle, you have to be able to access both. But yeah, so this is what we've created for India is it's vastly different in terms of overall structure because it's not limited to just its one city. We launched in Mumbai, but which is Bombay, and but our MLS that we built there is a national MLS. That means anyone that comes on, they actually have access to property listings throughout the country, and that's our first project. And the second project after that is going to be launching what we call a consumer facing or a B2C. The MLS is a B2B. Our next project would be to launch the B2C, which takes all of this valuable data. Today, as you know, it's not the revenue that you earn, it's the data that you have. The data is worth much more money
Yes, it
than
is.
any kind of revenue you may be generating right now. So that's the key. So we want to take that valuable data and then distribute it to the general public, similar to what we have in the US, which is like Zillow or realtor.com.
Yep.
So there are sites like that currently. All the countries, they have sites. But the problem you're going to see in the majority of them is that the data is not authentic. It's not legitimate. Many people put fake listings, and you say, why would somebody put a fake listing? And really, it's simple. It's because what they're trying to do is use that tool, that website, as a lead generation tool.
Yeah.
So they put up a listing that looks amazing, put beautiful pictures, price it about 20% below what would be considered a fair market value or even below that. And what happens? People see that and say they want to call them up right away. Hey, is this available? And the first thing that happens, the guy says, oh, no, I'm sorry. It just got sold yesterday. But don't worry, I can show you something else. And that becomes a lead, you know? But it's frustrating. It's frustrating for you as a buyer. It's frustrating even for other brokers. So long story short, we saw the need, we developed the product, and that's a whole separate business which runs, and that's on the other side of the world. But yeah, I'm proud of it, and we're just scratching the surface.
But that's amazing. I mean, out of all my 8 years of podcasting, you are the only person I met that has branched out like that into other countries doing what you do. Like, that's amazing. That's a really great idea.
It's a challenge.
So now the key is to get India hooked up to the United States. So they can go, hey, let me see what I can
that's coming
there, or what can we buy over there? I know it is coming. But that's amazing. That's really good for you. It's like, you've been investing 30 years. So I've been 35. So we've seen everything. And you hardly ever see anything that's new or fresh.
Yeah.
So I'm like, hey, what a good way to start off my year with a new fresh thing with the guy that invented it. I feel really honored now. So
we've got that, and then of course the big thing that we have here is the Proptex funds, and that's really my new baby that I'm happy that I'm excited about.
So is that a syndication?
No, so it's actually different. It's not a syndication. I'll tell you what it is it's a fund. It's a real estate fund, right? So the genesis of the Proptex funds happened like this. I mean, I never set out to go ahead and create a fund. Long story short, I'll give you the quick 2-minute synopsis. Like I said, I've been in real estate for a long time. We make our mistakes when we learn the most from the mistakes we make. So over the years, I've made some mistakes, but at the same time, I've had some good success. And I thank God, because if we hadn't, we wouldn't be where we are today. And one of the things that I learned was how to build a portfolio of properties that ultimately gives you enough passive income that it can replace your full-time job or your paycheck, if you will. And that's important for me because now, as I'm getting up around 55, I'm looking at retiring in the next few years, and I want to make sure that I have enough consistent cash flow that I don't have to worry about, am I going to deplete my savings? Or will I have enough in case I live a long life, right? I mean, one of the things that we do, my Instagram profile, by the way, is redefining age. You just say, why do you have that? Because I believe age is a number. And why do I bring that up? Because we focus a lot. It is absolutely a number, right? I mean, we focus a lot on health and fitness. And what do we do that for? Because we have a better overall lifestyle. We can spend more time with our kids and ultimately our grandkids.
Yep.
And we can live a long life. Well, what happens if you live a long life, but you haven't saved enough money? What happens if you don't have a plan that's going to be able to allow you to maintain your principal, your savings, without depleting it, and you can actually just live off the interest? You're going to outlive your money. And this is one of the biggest concerns. So Proptex came about as a result of me talking to some of my friends who said, hey, Jay, you built this thing. Can you help me in terms of building a portfolio? So I helped a couple of guys, and the problem with that is you can't do this on a one-on-one with many people. It's not really scalable. And we said, so what is the easiest thing to do? And we got a huge group of friends. So we said, look, let's set up a fund. If you like what we do here, put your capital in there, and then I'll manage the whole thing, and my team does. So we have 4 different divisions in the company, right? Excuse me. We have acquisitions, we have underwriting, we have the management side of it, and then we have dispositions. So acquisitions, that team just focuses on really ideal properties that we want to buy, properties where we can have built-in equity. So one of the things we love is foreclosures, short sales, tax deed properties. We're buying these properties at well below the current market value. And that means, and this is so much different from like the stock market. Tomorrow you buy a stock, you have no idea if that's going up or down. You have maybe some idea, you have a hope more than an idea. And that's why you buy it. You say, okay, I believe this is going to go higher. But wouldn't it be nice if you bought a stock and you knew that, hey, it's going to be 25 or 30% higher tomorrow?
Yes.
That's kind of what we do in foreclosures or short sales or even tax deeds. We're buying them so far below the market value, and we know what the actual fair value would be because That's the beauty in the US today. We have the MLS. We
Yep.
have all this data that we can pull from and get actual live comps. So you know what a true comparable price is. And you say, okay, it's $1 million property. I can buy it for 700,000. That's like making over 30, it's actually more than that. If you look at it, if you put $700,000 in, it's worth $1 million. It's not a 30% return. It's greater than that.
Yes.
So it's better than the market. It's predictable. It's stable. It's not going to go to zero tomorrow, which I love. I've got some scars from the market, and I didn't want that in my retirement. So we ended up deciding, right? So that's how this whole thing, that's the genesis of the Proptex funds. We built it so that we're delivering 11% to the investors. We, meaning Jay Patel and my team, we don't make a dime until first 11% is made by you or, as the investor.
Yeah, I
We
love
don't
that.
charge any management fees. That's not how it was. Yeah, it's not. And then also the other big thing is, and I'm sure you're familiar with real estate. Most funds or most syndications, like you were asking me earlier, they're typically going to be 3 to 5 year lockups.
Yes, that's
Real
why
estate's
I'm
not a
happy
liquid
with the
investment,
syndication because they're like
historically.
a set amount. Yeah.
Yeah. So it's not a syndication. That's the good news. You only have a 1 year lockup, which is the bare minimum. That means that after 1 year, you can pull out with just a 90-day notice. Say, okay, look, I need it by next quarter. No problem. It's pulled out. That doesn't happen in typical real estate funds. So you have tremendous flexibility. You get nice 11%. And then you have two options. Option number one is if, let's say, you're retired and need the income. Well, then you get the quarterly payments every single quarter. If you don't need the income and you're not quite retired yet, and you're like myself, I'm 55, I want to be retired at 60, 65. So I want my money compounding, right? The power of compounding is really where you truly make money. You might say, oh, 11% is not really sexy. It's not a really high return. But would you believe if I told you that if you took as little as $100,000 and you put it into something that could give you a consistent 11%, that 100,000 in 10 years would be $295,000 based on compounding. That's phenomenal. Because what we're doing is it's actually 283, but because ours is quarterly compounding, it actually grows to about 295,000. That's 3 times, almost 3x. So that's huge. Many of my peers, and most of them were professionals in the corporate world, well educated. They did extremely well. They've saved up money. They got 401ks, IRAs, etc. They're really good at what they do, but what they're not good at is the investment side of it. And they admit it that this is not our strength, just the way my strength would not be what they do. And so, they recognize that we need to do something with it. And if they were to take it, and I should basically show them, you take, say, hypothetically $500,000 and you put it in something like this, that $500,000 becomes about 1.5, close to 1.5. I think it ends up being like 1.42. 11% on 1.42 is over $13,000 a month. Now, I think most people today can at least, live comfortably without having to change their lifestyle significantly. And we're able to accomplish that with as little as $500,000. So it's not, the biggest fear a lot of people have today is, do I have enough money saved up, right?
No,
And that's what
true.
you start thinking about when you get to around 50, 55, 60.
It's true. And
this is what the conversation has been, haven't it?
No, so I'm 66 and I've been investing for 35 years. And it's like, you start thinking, oh, maybe I want to retire. And I love the fact that you have a fund opposed to like a syndication. But a good example is my dad retired. So I'm from Ohio. So I was raised up in, near you from Chicago. The blue collar, get a job. I graduated high school in 77. So the deal was for the girls was get married, have kids, and work at a factory and work for the man. Retire when you're 60 and da da da. And so my dad did that, worked for the man, the factory, and retired at like 57. Well, they've got all their money in mutual funds and da 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 da. And around 70 years old, my dad calls. He said, listen, my wife Lois, my stepmom, called my little mama. He goes, we've been going through our money. And he goes, at the rate the market is going down, he goes, we don't have enough money to live on. And I was,
Oh,
and this
man.
is like, now you're 70 and you've been retired for over a decade. And you're thinking like, I'm going to run out of money. And so at that time, he passed away last year. So that would have been like 17, 18 years ago. I said, listen, you guys are sitting on gobs of money. Why don't you buy rentals? because they live in the country. I said, get some rentals in the little
Mhm.
town, pay cash, or give you guys something to putter around and, fix up and work on and just get you out of the house. Anyway, so he bought a couple of rentals, and all of a sudden their income went from whatever their fixed income was, maybe 2,500, it was like $8,800 a month. This is a
Wow.
70-year-old man that was like, worked for the man and retired, and everything he had was paid for, and everything's got to be in your name, and that. He's like, do you know how much money we have coming in now? And I'm like, yes, I do, thank you. And I was investing for decades. I have an old school dad, so he was like, you need to get a real job and insurance and 401ks. You need a real job.
Right.
That investing, that's not a real job. And then in his old age, he's like, hey, listen, tell me how to do what you're doing because I'm running out of money. And it was a real fear. They were like really terrified they ran out of money. And then they ended up living like super high on the hog. Next thing you know, they're traveling to China and they're going here and they're going there and they're
But
just,
isn't that
and it's
Juan,
like,
isn't that what retirement's supposed to
it's
be? I
supposed
mean,
to
right? You've
be.
already,
It is. And I
right?
was really proud that I was able to help my dad because, and they were still living a good life. I mean, they were doing things, but they went like first class everywhere. They were like really doing it. And I thought that's what retirement should be. But people
Yeah.
are still kind of have the mindset of, I got to save and scrimp this and save my social security and da 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 da. Maybe I'll have, you know, $4,000 a month to live on when I retire. It's not enough. Hey, just a quick break. I hope you're enjoying the most wonderful real estate podcast ever. How many breaks, how many nuggets, how much information have you gotten so far today? This podcast is great. They're all great. So stay tuned and back to the podcast. But before we go back, follow me at Dwanderful, DWANDERFUL, Dwanderful.com. Be a part of the podcast, the webinars, the workshops. Be a part of everything. Back to the show.
No, it's not. Especially you have to consider that inflation is fairly high nowadays compared to, even what it has been. So the value or the purchasing power of the dollar is not what it was at one time, and it definitely is not what it's going to be. It's going lower and lower, right?
Yep.
So it's super important that whatever you have your money in it, I don't care if it's in real estate or the market or bonds or whatever it is, it's got to outpace inflation, or
It
you're
does.
already kind of like behind the eight ball. So you've got one problem is the inflation. Number two, you're potentially dwindling your savings. Like you said, yeah, if your father was concerned because he sees that, okay, I've got X amount, whatever that amount is, it's coming down. And if you're going to outlive that, if you're going to live a long life, you're going to outlive that amount of money. So what are you going to do? And it's good that he was actually, a lot of times what people do, and this is obviously the worst thing to do, they kind of sweep it under the rug. They don't think about it and say, okay, I'll deal with it when the problem happens. And, listen, I'm guilty about that too in other respects. But when it came to this, it's a top priority because this is like, you want to be able to not have to change your lifestyle. You have a certain lifestyle that you're used to. I don't want to now suddenly, not be able to travel or not go out to the nice, dinners or whatever I want to do. I want to be able to spend time with my kids and all those things, even when I am retired, because that's the biggest problem is that many people face, okay, I may have to, curb my lifestyle, maybe not travel as much. Because once that paycheck stops coming in, you become, it's a finite amount of money that you have. And what are
It
you going to
is.
do? So the whole objective is that just make sure you have a plan. And so a lot of my friends at least I was speaking with, I helped them get into a few properties. And let me tell you, they're happy, they're great, but it just wasn't scalable. But the fund allows me to do that because now I manage one pool of capital. We're buying these properties, like even my own property here that I live in. I bought this home as a foreclosure property. Of course, we fixed it up now and it's worth double what we got it for.
Yeah.
And that's built-in equity, which is fantastic, right?
Yeah.
So this is what we do for our clients. And so we have three different verticals, just to kind of give you a little bit of
Yeah,
background
I
on
want to hear all
Proptex.
that.
One is what
I
we talked
love the
about.
whole topic. I'm I'm actually, I don't mean for this to sound, I don't know, I don't mean for this to sound like I know everything. But it's not that often I talk to someone that like has something that's like new to me. So, you know what I mean? 'Cause everyone does the same thing. So I love you telling everything about it because this is new to me and I'm excited about it.
Cool. Well, no, I appreciate that. And by the way, I know you've done extremely well for yourself. So the advice you gave to your dad was priceless. That it changed your lifestyle. We're trying to do the same thing for our clients. Our fund really is geared more towards people that are, maybe late 40s up to early 60s,
Yeah.
or even older. I'm saying that would be our ideal or target person. That's not to say that someone in their 20s or 30s, if they're prudent enough and they're thinking long term, this would be a great option for them too. Because if hypothetically, let's say they save and they put 100 grand in, which by the way is our minimum, if they put 100,000 in, every 10 years, that money's tripling. So imagine in 30 years, in an ideal world, if everything goes well and you get 11%, that 100,000 becomes close to 300,000, becomes close to 900,000 within 20 years, becomes close to like 2.5 million, 2.7 million. That's incredible from a $100,000 amount within
That's
30
huge.
years when they're retiring. If somebody told me that when I was 25, I don't know if I would have believed it, but that's the way to go. You get in, you put $100,000 and you can basically retire on that money. It's amazing. So you're outpacing inflation. So anyway, going back to our three verticals, I mentioned one is we love distressed type properties. We love these properties because we can go in, we've got built-in equity from day one.
Yeah.
What that does is it eliminates, or at least it diminishes significant downside. We already know that unlike the stocks, our property is not going to go to zero. Stocks can go to zero. They can have massive volatility. You're not going to have that same level of volatility in this. And something you had mentioned earlier was actually, it's interesting because what your father had experienced is something called, it's a sequence of returns risk. And what I mean by that is you can have the S&P can go up 10%, which is the average, by the way. If you look at the S&P's returns historically over the last 10, 20, 30 years, it's on average about 10%. Now, 2025 was an anomaly because it was up like 16 to 17%. There's a pro and a con to that. The first is, wow, fantastic. If you had money in the market, you did great in that 1 year.
Yeah.
But the negative could be, okay, it's overextended. One of the things that we look at very closely is the Shiller PE index on the S&P 500. And that's well over 40. Just to put that into perspective for you, and I'm a big technical guy, I'm a numbers guy. A Shiller PE index of 40, when the max that it's really ever been is 44, means you're really near the top, and it's dangerous territory. It's overbought territory. The average or median Shiller PE index is about a 17, 18. So that's what we consider a healthy, nice, consistent growth. But when you get overextended, there's a chance for it to correct and pull back. So this is one of the things that, it's an important indicator for us, and it should be even for your listeners if they're invested in the market. We're at a point where the market's gotten a little bit overextended. Even today, as we speak, it's up again after being down quite a bit. This morning it was down, I think 300 points. It's come back. But the point I'm making is, in life, things can, not just in the market, but anything, if it gets outside of its norm, it eventually pulls back.
It
right?
does.
And so one of the concerns I have for the market is that it could happen. Now, if you're invested, do you want to be in there where it could come down, or would you rather put your capital in something that's just consistently going up 11%? And that's kind of the model that we built it on. But that sequence of diminishing returns, or that returns risk that I mentioned, is this. When the market goes up like that, you say, okay, I make a big gain. But if it drops now, say, let's take a 10 or 15%, if it comes down from that number, you say, oh, yeah, but it was already up 16%. It's only back down to where it started. It's actually a greater painful, like it's more painful than if it had just gone, if it had stayed there, because now you've got that coming down, you've lost those 2 years of time. When you lose that 2 years of time and the potential income, that compounds. So it actually hurts you even more. And remember, inflation hasn't stopped. Inflation is still growing at whatever, 2, 3, 4%. So that's going to hurt you in the long run. So long story short is we love the distressed properties that we can buy at huge discounts. As I mentioned, foreclosure, short sales. I've done some of my best deals in tax deed investments. We're buying these properties.
I
don't know if
like
you have
tax deed investments. A lot of people don't do that or understand it. I used to do that way back in the beginning when I really didn't know anything. I thought this is like a really fun way to invest.
Yeah, it is. And if you know what you're doing, you can get really nice, consistent, anywhere from 12 to 18%. Depends on each state to state. Those are more on the lean side.
Yes.
What we prefer are the tax deeds, where we're actually buying the property, buying the deed to the property. And I have a bunch of property right now that we bought in Alabama. Pennies on the dollar. When I say pennies, Dwan, you wouldn't believe me if I told you. We bought these for 10 cents on the dollar. Now, granted, they do need a lot of work.
Yeah,
so we
that's
put
all right.
the money in, and we we upped it. It's all right. Exactly. So as long as you have the outlook to look, this is not a get rich quick. Real estate is a consistent, steady, you have a plan, you're going to build a portfolio, you're building wealth. You're not trying to get rich quick. And as long as you have that understanding, you're going to buy this thing for, let's say, 10 cents on the dollar. You're going to have to put another 50, 60 cents in there on the dollar. So you're in for, let's say, $60,000, $70,000, but it's worth over 100 or 120,000. You've got significant positive equity. So what's the next best thing to do? Instead of leaving your money tied up, you basically do like a refinance. Many of your investors may be familiar with a concept called BRRRR. It's where you buy and then you rehab, you rent it out, you refinance it, and then basically, you repeat the process, and that's the BRRRR. And what that does is it gets your money back into cash. You got no real risk into that property right now because your money's back in cash, and you're getting positive cash flow every single month because the property's worth 100 and some odd thousand. So you're able to pull some money out, you get positive cash flow, and you have no money left in the deal, which is fantastic. So I've got a bunch of properties that we bought in Alabama. We've got some other states. These are huge wins. So that's one of our verticals.
I love that, though.
Some good money,
I'm a big
and
fan
helps us
of buying everything dirt cheap. I mean, I've done over 2,000 personal deals by myself, and they were all foreclosures.
I saw that, by the way. You've sold what, about $500 million in real estate or something like that?
So much. And I don't know, you probably don't know this, but I actually am the very first person that actually trademarked the term short sales as it applies to real estate investing. And I wrote the first short sale I wrote the first short sale program for real estate investors back in the 90s and trademarked. So I have the short sale, I have an R that as it applies to real estate, because short sales is used in the stock markets, is used in other industries, but as it applies to real estate, I actually own the registered trademark for short sales and the queen of short sales.
Good for you. It's amazing.
Yeah, I know.
I had no idea.
I helped
that's something that we love because this is a big part of our business.
Yeah, I helped invent
an
entire industry.
So that's one vertical.
Okay, I love it.
Second vertical.
Give me another
The second vertical that we have. Okay, so in this vertical, we love investing in properties that are strong cash flow properties. Yeah. Remember, the first verticals we're buying super cheap, so we've got like 20, 30, 40% equity built into the deal. The second vertical is where we're buying properties that are going to be really good, strong cash flow properties. So say, Jay, what does that mean? Give me some examples. So first and foremost, what we love today, my number one at the top of the list, is assisted living centers, like residential assisted living. Why is that? And this goes hand in hand, right? You're laughing because you probably know where I'm going with this.
Because I love assisted living. My husband and I, not to interrupt you, my husband and I are like, we need to open some assisted living and call them like rock and roll assisted living. Because the people living in there that are in their 70s and 80s, they were teenagers like in the 60s, and they were, hippies. And let them smoke weed and drop some acid and dance and play like the Rolling
Why
Stones.
Not? They deserve it. They've lived a full life. They work their butt off. It's time to enjoy, right?
Why not? I'm telling you, I think it would be so much fun. It's like,
absolutely. So that's one of their. I'll tell you something. What's really interesting today in America right now, they're just talking about the U.S. In the U.S. right now, we're short by over 1 million beds because the baby boomer generation is now just turning of that age. We're going to need that assisted living, right? And that is creating a major shortage. Yeah, and what that means is that shortage is an opportunity for people like myself and our fund. Yeah. So we invest in these properties. We basically set them up turnkey. Now imagine you're someone who is an operator in that space. You would rather come and take one of mine, which is already built and it's beautiful, it's turnkey. You'll be willing to pay a higher premium, which is a higher rent, even put up a bigger security deposit, because it's going to do two things for you. One, no headache in terms of getting it going. And two, think about all the time and money. You don't have to lay out the money. You don't have to deal with the headache. You got a turnkey solution, and you're willing to pay a premium for that. And that's what we get paid for. So our returns on those residential assisted livings are fantastic. We know they're going to be full. We know that as long as we got a strong operator, by the way, we're not in the business of operating them because we're a real estate company. We are like the landlords. We want to bank property, right? But we want to make sure that these properties are strong cash flow properties.
I agree.
So assisted living, we absolutely love those. Co-living, something else that's been really taken off in this country is co-living. We like those. We've also converted some of our Airbnb properties, which is another holding we have, into co-living properties, which are, again, it's better. I call it like rental property on steroids, because where you might make, for example, 3 or 4,000, you're familiar with co-living.
Oh, yeah. Oh, yeah.
So you're getting almost 25, 30%, sometimes 50% more than you would on a rental property. So that's our second vertical. First was buying properties at deep discounts, whether it's foreclosure, short sale, tax deeds. Second vertical that we have is where we're buying really strong cash flow properties that will consistently deliver, above average returns, double-digit returns. And everything is measured on a cash-on-cash basis.
Everything.
So we want to make sure that our cash-on-cash is in double digits, right? Our third vertical, now this is interesting. We believe that all money should always be deployed as much as possible. As a fund, if you have money just sitting in cash, you're not making any money on that. And therefore, the entire performance of the fund can come down. So I'll give an example. Let's assume, let's take a round number, $20 million. If there's 20 million in the fund, but 10 million is deployed and it's generating fantastic returns, let's say 20% a year, but the other 10 million is sitting in cash, what is the net return of that fund? Because 50% is deployed and 50% is sitting in cash. The 50% that's generating 20%, it's really giving the fund, the net return for the fund is only 10%.
Right.
That doesn't cut it. We need to be above 11%. So what that means is the money should always be deployed. So how do we ensure as a fund that even if our projects, let's say, for example, we bought a property, did it, we bought a foreclosure, we sold it, we made some money. That's fantastic. But what we do for the excess money, if it's ever there, it's sitting there, is we have a bridge lending business. So that means we help people in real estate get short-term bridge loans at 12% or higher. We're fully collateralized because we're loaning the money out at a wide enough loan to value, where, let's say, for example, 70% of or 65% of ARV, 75% of ARV. So we've got enough cushion that's in the deal, and we have a lien in the first position. So we know that should anything ever happen, we can take over the property. And then we're getting 12% up front plus 2 points. So you say, okay, that's not bad, but you're only making 14%. Well, here's where it gets really exciting. We don't do these loans to hold them. Because remember what I told you, we're a real estate investment company.
Yeah,
that means we want to truly invest our money into the other projects. Our money, we don't want it sitting idle. So what we do is we make these short-term bridge loans or loan for people who are flipping. Once we have 4 or 5 of these loans, we package the loan and then we sell those to a hedge fund or a pension fund. Now, you may have seen or you may have experienced it yourself. Even your conventional loan that you have with which XYZ bank, you'll find that many times your loan, you get a notice that it's been sold. Why do banks do that? Because what they're doing is essentially they're selling the loan off, get their cash back in their hands so they can make more loans. They're making money on fees. They're making money on points and a number of other things, right? So they sell their loans to funds that are happy making 8, 9%. So where I was getting 12 from the client who wanted to borrow it, I've now sold that to a fund that wants to only make 8 or 9%, thereby creating a 3% arbitrage for us. So we're going to make 3%, and already our money's back in cash. Plus, we make the additional 1 to 2 points for the origination fees. So we're making between 4 to 5 points on these loans, and we don't really have any risk now because the cash is back in our pocket. It's a fantastic business.
You guys
so
have
that allows
every
us to
angle
make sure
covered.
that
I love it.
Well, the whole idea there, right, Dwan, is that even though we're a real estate fund and we want to deliver strong double-digit returns, it's got to be done in a prudent way where we're not overexposed on risk.
Yes.
And the way we do that is, like I said, because we're buying properties at significant discounts, that protects that side of it. But what about the cash flow? So our cash flow is covered because we've got good, strong investments, but that would mean that 100% of the money has to be fully invested in that.
Yes.
But that doesn't give us the flexibility to take a good deal that comes along tomorrow. So our capital must be available and ready so that once a great foreclosure, short sale, tax deed opportunity comes along, we can plop down the $2, $3, $4 million, whatever's required, and we can take that down right away. But in the interim, the money should not be sitting idle. So I hope it kind of gives you an idea. This is where we're able to deliver and how we're able to deliver the 11%.
I love it. Now, I feel like I just had an entire seminar just directly for me. Such good information, such good information. So now, someone wants to invest in your fund. You said there's $100,000 minimum.
True. Our fund is designed for accredited investors. It's
I was
not
going to ask
just
you that
for,
too.
somebody who wants to put in 10,000 or 20,000.
They
Yeah,
would
it's
think that
important because we want to work with people that understand. Ideally, like I said, when we opened this initial podcast, I mentioned that our ideal candidate, our ideal client would be someone who's maybe 50 to 60 years old
Yep.
and is thinking about retiring in the next 5, 10, 15 years. They want to make sure that they've got a strong plan in place. And if that constitutes, it doesn't matter if it's only 100,000, 300,000, 500,000, whatever they're comfortable. And we never tell anybody to take on any more risk than they're comfortable with. First of all, we do manage risk. Our number one priority in this fund is capital preservation. Return is second. So because why? We're at that age now, we don't want to take that level of risk. I started the majority of my business, of course, naturally, as you get older, you become more risk averse. But when I was younger, I was a serial entrepreneur. We did many things, and that's where the last thing you want. There's a quote that I read recently, and I think it'll resonate. The people say that success comes at an expensive price, and what is that price? You gave up a lot of time, you made sacrifices, you invested a lot of money, etc. But the greatest risk or the greatest cost is when the bill arrived for regret. So you don't want to look back 10, 15 years later and you say, man, I regret I didn't do this, because that's going to hurt you way more than the things that you did looking back. And besides, the work that we put in, we work hard. We learn a lot in the process.
Yes.
As I said before, I was involved in the market. I've done my real estate transactions. We've done stuff all over the world. And believe it or not, we've lost money in some of those deals.
Yeah.
But where you learn the most, unfortunately, is from our losses. So today we're happy to say, right? Isn't that true?
Now, I tell people
when you make money, you think you're a genius.
Yeah, you do. And I tell people all the time, it's like, listen, if you want to be involved in real estate investing, initially, you need to have a fairly high risk factor, because even if you're just doing like a single family home, if you underestimate repairs or time or whatever, you can lose, whatever, your little mini
You
life
can.
savings.
So that's the thing that people need to understand.
But that's why I like things like this.
Yeah, real estate, you can.
You've got it. People put the money in. There's
Exactly.
no risk.
It's about mitigating risk. So listen, first and foremost, if anybody ever tells you that there's no risk, you should run the other way, because they're not being truthful. You want to deal with people that are transparent. If there's only one of two reasons why somebody's going to say there's no risk. One is they don't fully understand it. They're not knowledgeable. They don't recognize it, or they're not being truthful. And because in reality, there really isn't an investment out there look, I'll tell you something. Tax deeds. Okay. A tax deed or a tax lien, for example, can deliver you anywhere from 12 to 18%. For example, the state of Illinois, we get 18%. I believe in the state of Florida, I think that's where you're at right now, it's like 18%.
Yeah.
But does that mean that you could just buy any tax lien? No, because if you bought a lien that really has no interest or demand out there, no one's going to come back and redeem that, or who's going to pay you the interest on that. So you still need to know what to buy, when to buy it, how to buy it, etc. So just because tax liens pay that doesn't mean, hey, I have this. That's the most dangerous investor, who has maybe 10 or 15% knowledge and believes that I know everything, because now they go out there and they're investing in these things, not only to realize, oh my God, I didn't realize that this is a situation. So we always advise, look, don't trust me. Do your homework, right?
Yes, you're preaching to the choir here. I tell everyone, just not to
absolutely. I mean, you've done it.
Listen, I'm like, there's so many people that are good marketers. So you see them online and go, oh my gosh, they look amazing. I'm going to work with them. So yeah, but just because someone's a good marketer doesn't mean they know what they're actually doing behind what you see on the internet. Like, you got to find people, you've got to research, you have to see how long they've been doing it. Are they actually successful in their field? Because people want to chase, the next podcast or the next seminar and inspire the next shiny object. People want to chase all the shiny objects, but that's not where you don't make any money. That's where people lose everything.
No. And there's so many.
And it didn't work out.
That actually drives me nuts, Dwan. I'll tell you something. How many times do you see? And listen, first of all, I'll commend them on their marketing ability. But a lot of these 20 and early 30-year-olds, They're young. There's no way they're going to have, 20, 30 years of experience. Not
There's
even
no
20, 30
way.
themselves. So my point, so they're incredible at marketing online. They can get a ton of followers, and then they're selling, high ticket coaching courses and things like that. But really the value comes from experience. And that's having been there, having done it, cutting your teeth on it and taking your law. I mean, you've been there. We're like old school, you and I. But the thing is, like, this is what gets us to where we are, where we can at least show that, look, there's ways to make money. There's also ways to lose it. You got to know how to manage that.
Yep.
How do you mitigate your risk so that, and don't assume that there's no risk. There's always going to be some level. The question is, how are you going to manage it? And so that's one of our biggest takeaways, is that just to make sure you know what you're getting into, and then making sure that it's covering what your non-negotiables are. If, for example, if you're hypothetically 60, 65, and you just don't want to take any risk whatsoever, then there's always T-bonds and things like that you can buy, which is a much lower level. It's backed on by the government, et cetera. You're going to get a lower return. So today, what can you do to make sure you are able to combat that? And what I always tell people is asset allocation. So you should have an appetite to have a little percentage. So let's say hypothetically, you've got $1 million portfolio. I'm not saying you have $1 million in cash. You may have some in a 401, you may have some in your IRA, you have some in your home, you use your equity, et cetera. But your net worth might be, let's say, $1 million. Question is, what are you going to do with that to ensure that you're going to have not only that, but hopefully more than that, plus income generated from that, right? We work hard. Like, we work our butt off for our money for those first 30, 40 years. It's time that money starts working for you.
Yes.
So you can't just leave it sitting there in equity in the home, or leave it sitting there in cash, which is being depleted every month to survive on. How are you going to asset allocate that? So if your tolerance for risk is super low, okay, fine. Put majority of that into, let's say, T-bonds or bills or whatever you're comfortable with. Even some annuities can give you some decent returns. But the point is, make sure you're diversified. That's the key word I want people to take away, is if you're going to allocate, maybe allocate something, even if it's 10 or 15%, 20%, to something like a Proptex, because it can deliver you a decent return that will make up for what the others are not doing for you. And then you have the majority of it that's sitting in that asset class. So it's not like it's going to go to zero or anything else like that.
So asset allocation
Let me jump in. Let me ask you
a question. So someone is listening to the most wonderful real estate podcast today, and they're like, I've never heard of this. I've never heard of this guy. He must be pretty good because Dwan's got him on her show. So someone that wants to work with you or discover you, like, what would be the first step for somebody that's like, I'm interested in what Jay's saying. What would be the first step they take to get into your realm?
No, I appreciate that. And I think the first,
because
first of all, I wouldn't
are not going to know you. So
no, and I wouldn't advise anyone to plop down any cash until you, not even whether it's us with somebody else. So first and foremost, the nice thing about Proptex is we're extremely approachable. It's not like these big funds. When you go to fund, you'll never get a chance to talk to the fund manager themselves.
No.
I mean, think about it. You've got these funds like Blackstone. Okay, Blackstone's great. A bunch of other funds are great. They invest a lot in real estate. But could you pick up the phone and call the fund manager? 99% of the time, absolutely not. And if you're going to get their attention, you're going to have to probably plop down a few $1 million for their, just to even get their attention. So first and foremost, if somebody's genuinely interested, they want to learn more about it, either it's about myself personally or about the fund, I always welcome a call. I'm happy to share my calendar link. They can book a call on my calendar, and it can be a 30-minute call, 60-minute call, where we actually go through and show them what we do, how we do it, the assets that we buy, some of the deals that we've done.
Okay.
So that way they can get a little better idea.
Second thing is, of course, so I like that. I always tell people, if you're going to invest a bunch of money with someone and they won't give you a cell phone number or number to reach them, they're not.
No, all of our clients have my number, so directly they can text me or call me. I think that's super important. Again, a part of that is maybe because we're not so big that we have, tens of thousands of customers. Otherwise, it can be as clients or investors, it would be tough. But also, we don't want to get to that level, right? We're very happy with what we do.
Yeah,
we know what we're good at. We also know what we're not good at. So, we stay within our lane, and our lane is providing a great return both for us as well as, the people that are now within our sphere.
If someone goes to your website, are there videos? Is there something for them to watch? Do you have calls?
Yeah.
Anything that people can be
so
like, I just want to listen?
Yeah, it's a good point. We just launched a YouTube channel, so
Good.
that's something new, which is cool. By the way, I'm a real estate freak, right? I love real estate, but I'm not a tech like a social media guy.
Oh
And
yeah,
this is
no.
the thing that's, this is all, I mean, we're still learning that. So I have to go on. So this is where those 20, 30-year-olds are great because we bring them in to say, okay, guys, you're good at your marketing. Why don't you do that? Let me deal with the real estate. And
Yes.
so they're now helping us handle the social media. They're building that for us in terms of we've got a YouTube channel. We've got our Instagram profile. You can see some videos on there as well. It's like I said, it's a new profile,
Nice.
but I
Okay.
welcome people to follow it. It's just at Proptex Funds. And then you can also visit my LinkedIn, which a lot of professionals and business people will go, and they'll see a lot of my personal experience on there, which
Yeah.
talks about, over 10 years working on the MLS project. I've been in real estate in terms of, I started out as just as a simple investor. I ended up getting my license because I realized that if I have my brokerage license, then one, I can find properties easier. And second, I can avoid, one whole side of the commission because now I'm essentially acting and representing myself. But that opened up a whole new door for me, which was fantastic. I mean, that opened me up to, actually now I'm a professional, real estate professional, rather than just an investor. And that's where we got the whole, the business started back in the late 90s. And we've even built a 200 plus housing community. You're currently in Florida, where I actually did that in Central Florida. It was a senior, it was a 55 and over community, but it was huge. That was one of my largest deals way back. This is
The
going almost
villages?
20 years ago. No, it's in Sebring, so it's not in the you're down south, right?
Yeah,
And
I'm
you
down
said
in Palm Beach
Delray.
County.
So this is more central. It's a little bit further north. We've done since then larger apartment building deals. We've done, I don't know. By the way, a side joke. You've probably saw, and my last name is Patel. Do you know what it's synonymous for in the real estate industry?
No,
Okay, so I told you my nationality is Indian.
right.
I don't know if you noticed this, but majority of the motels and hotels in this country are owned by the Indian population. So the joke has always been it's the Patel Motel or the Patel Hotel, and it's like you laugh, but it's true. Would you believe 80% of the motels around the country are owned by Indians?
I
It's like
I
it's
know
not
they
just
are. I stay, I travel, I go to little places, little boutiques even, and they're all, yeah, I'm like, wow, they've got the
Right. So
market
different
cornered in the whole
different
country.
nationalities have carved their space. We're immigrant. Like my family is first generation here. We came here with nothing. You have to build it. So the biggest focus that my parents had, obviously, when we were growing up, was all on education.
Yeah, of
And
course.
even though we had nothing, we work our butt off at the end of the day, and so that you could build, you can make something of it. So the Indian population, when they first started immigrating to the U.S., they were known for obviously hard work, but then they became entrepreneurial when they opened up businesses. And why do they do that? Because then they can control, their own destiny, if you will. They can
Yes.
build their wealth. And many of them open up these
And the
motels,
Seven
small 10.
Elevens and all the
Yeah, so
convenience
I'm just
stores.
getting to that is that the three industries, hospitality, hotel, motels was huge.
Yep.
Convenience. So we owned my own family, and I believe it or not, when I was in college, every day from 4 p.m. till midnight was my shift, and I worked that every summer, 4 to 12, 7 days a week. We ran my family's business, and so my parents opened that up. And even though my dad's an engineer by trade, and education, he ended up doing this as a side thing, then made it become his primary. So I've grown up in that entrepreneurial environment that we had video stores, we had, liquor. So today, 7-Elevens are huge in the Indian community. Hotels, motels are huge in the Indian community. Just the same way you find, like maybe, if I'm not mistaken, the Koreans, they are big into laundromats. The Filipinos are big into salons. So, there's different
No, it is true. Even like right
ethnicities
here in
that have kind of
Delray,
specialized.
yeah, there's a little liquor store called Pat's. That's like a local liquor store. That's run by a family that's all Indian.
Probably Indian.
Yeah, and they're always like, "Hello,
Yeah, no
Dawn." They say
surprise
my name
there.
with an accent. And I'm like, "Hey, what's up?" Because they all know me by
Uh,
name. Because
I'll tell you, I'll tell you one great thing about the liquor business. It's recession proof. So whether the market's doing, the economy's doing great, people are
ah,
paying. And
it
if it's
is.
not, then they're drowning their sorrows.
That's true. That
It's
is
recession
true.
proof.
That's funny. So I'm going to ask you some personal questions. Let's jump off business for a few minutes here.
Sure.
You've been listening to my shows. You know.
Sure.
I want to talk about you because one thing I know for a fact is that people work with people that they like. So you can have all the knowledge and skills, but people don't like your personality, don't like something, just like, and they find somebody else. So I
I
always
appreciate that.
like to talk a little bit about you personally, but we've already almost taken up most of the time, but I still want to ask you a few questions. So tell me your favorite band of all time.
Well, man, there's a few. I've always liked U2. My favorite individual artist was Billy Joel. I loved him because he wrote his own music and he played. I mean, he's exceptional, right? So yeah, these are some of. I'm an '80s guy, '80s, '90s music.
Yeah, yeah, yeah. Well,
Love
you
it.
too. I mean, gosh, they're like
What about
literally the
you?
biggest band. Well, I my favorite band of all time is Styx. So I
Oh,
started going, so
nice.
I'm a decade older. I started going to concerts in the 70s, and Styx used to open for like all these big. So I saw them probably 20 times, opening for all these really bigger bands until they became like the bigger band. So I don't know. I think because I started seeing them when I was like 16, 17, I'm like, oh, I love Styx. So just the music and
Hmm.
the whatever. But I'm like a Queen, Aerosmith kind of girl.
I love Queen.
Yeah, Queen's the best. Queen's like
What?
my.
How about that movie that came out a few years ago,
Oh,
Bohemian
Bohemian
Rhapsody?
Rhapsody.
That
Oh
was
yeah,
one of
I've
my
seen it like 3 times.
amazing,
Freddie
amazing. Love it.
Mercury, Freddie Mercury is like to me is like Prince. Like
So
they're like
talented.
an anomaly. There just aren't
Yeah,
people like that. It's like Michael Jackson. They're just like a once in a lifetime thing that you see there. So, but
I
yeah, you
agree.
two, you two's they're great. They're great. They're great. So you're Indian. What's your favorite food? Is it Indian food?
Man, that's I wouldn't call myself a foodie, but I absolutely do love Indian food. However, if I'm eating, so I get Indian food at home. If I'm going out, I love Italian, I love Mexican. I think my favorite go-to probably, I'm a pizza connoisseur, man. I've tried pizza all over the world and I love it.
I love
I love
pizza.
true Italian pizza from Napoli, like Neapolitan style from Naples. And yeah, I mean, we love it. Even like, I actually learned the difference between the Roman, the Romano versus the Neapolitan. It's very
Yeah.
different. But they're great in their own respect. So one of my favorite countries happens to be Italy. I love traveling there. Been there a few times and love the countryside, Tuscany,
Oh,
the
I
Amalfi
know. I
Coast is
love
my
Italy so
favorite.
much. It's funny. My
So
favorite food when I go out to eat is I go eat Indian food.
yeah,
I freaking love.
so you don't mind the spice at all. That's great.
Now, well, my husband orders everything like full spice, just whatever. I order everything mild to medium, but no, it's like if I have a choice to go out and eat dinner tonight, I would always go eat Indian food. I love it.
So
The kormas and the,
if I don't get Indian food for a week, then I feel like I'm deprived, like I crave it.
yeah,
Because once you've grown up with that, the taste, the spice, it's like explodes in your mouth. It's hard to find that in other cuisines. So if I don't get it, then I crave it. I have to ask either my wife or even my mom to say, listen, I need some,
I
we
need
got to get
someone to
some good
cook
home
me some
cooking.
food.
That's right. That's one thing I'm not very good at, by the way. I have strengths and cooking is not one of them.
Yeah, it's not one of mine either. I'm more like I grew up in the South, so my family's from Tennessee, so I can make you pot roast, biscuits, gravy, fried chicken, but outside of that, it's like I need to go out to eat. So, all right, so
Yeah, all this talk of food is going to get me hungry.
I know I like all my guests at the end of the interview. I like everyone to give us a word of wisdom, but I want you to give me just one single word, a word of wisdom, a single word. And don't explain, just tell me what it is.
Okay. Diversification.
Okay, don't tell me what it means yet.
That's my word.
Okay, I'm writing it down. So all the people that follow me on the regular, they know that at the end of the call, we have a word of the week. It's our word of wisdom. I tell everyone to write it on a little sticky note and put it on your bathroom when you're brushing your teeth. This week, you're like diversification, diversification. That's the word of the week for everybody. So I want to know what that means to you because I know what it means
Well,
to me.
that's
What does it mean to you?
yeah. So that goes back to a lot of what we were talking about earlier. And like now everything about my life is built on, and I don't mean just in investments. I'm talking about in life in general. So you don't want to be, singular or just tunnel vision. If it comes to investments, it means making sure you're diversified around across multiple asset classes. If you're talking about life in general, you don't want to be one dimensional where you're working all the time. You got to fit in fitness, you got to fit in social life. And they say, like, as you're getting older, you need, people who live a longer, healthier life are those who are also socially active because their stress levels are low. And so all of this, so for me, that one word actually means more than, but it happens to also relate to investments, which is great, but it means more than just investments. But when it comes time to, especially with like retirement, it is super important to have diversification. In your life, it's super important to have diversification. And the same way with food, like we were talking about food, I can't have the same thing every day. I want diversification. I want Italian. I want Mexican. I want Indian. If I don't get it after a certain amount of time, I crave that. So I think the long and short would be keep it spicy, keep it different, mix it up a little bit.
No, I could not agree more. When you first said that, my first thought is on my podcast, I say, listen, you can't, your life isn't about money. It's got to be, you got to have like that. I call them the 5 equities of life. You've got to have finances, you got to have spiritual, you have your mental health, your physical health, your family and your friends. Like you have to, if you just do this one thing, your life is going to be missing too many pieces. And, people work and work and work and work and work and work, and they don't take time for vacations or health or whatever. And the next thing you know, they just like drop over dead. It's like, okay, but how much of that money did you just take with you? Like, you got to do.
What was it all for?
You're more than in one single aspect. So I was really happy you said that word, because I feel like that's what I would say to someone is, real estate obviously do lots of things, but your life needs to have multiple aspects. Really, I feel, to be like a whole person. It takes all these pieces to make us whole.
Yeah.
Not just this thing. So I like that word. Okay. So I always like to have the guests tell us what they think that it is. And I never let anyone know in advance I'm going to ask that question, because then you'll think of a word before the show, and then throughout you'll be thinking I should change my word. And so I just want to ask you what your word is, because you paused, you thought, you looked up, and you're like, you chose a good word. And so that's the word we're pulling out of the hat this week, is diversification. And I like what your meaning of it is. It's the same. I feel the same way. People just can't have all your eggs in a single basket.
No way.
So
that's the recipe for disaster.
It is a recipe for disaster. So listen, I want to thank you for being on. You have been so much fun, and really, I have like just pages of notes, really a fountain of information. And I really like that, because, you've been on podcasts before. Well, you've been on them. When you have guests, sometimes you got to pull teeth to get people to talk and answer questions. And, they're not always as easy, because people get shy once they know they're on camera. So I appreciate your openness and willing to share. And you gave us like so much information, and I appreciate it about you. And I also want to thank you for your time, because time is also one of your most valuable assets. So I appreciate you spending an hour with me, because it's an hour that you can't get back. So I appreciate that you spent it with me and with my Dwanderful family. We appreciate your time and your knowledge.
I thoroughly enjoyed it. Thank you so much, Dwan.
I did too.
We'll do it again sometime.
Yeah, we'll do it for sure. All right, everybody. So listen, we'll be back next week. Same bat time, same bat channel. And remember that the truth is in the red letters. All right, everybody. Goodbye. Jay, goodbye. Thank you. And remember, diversification is a word of the week.
Love it. Thank you. Bye-bye.
Thank you for listening to the most wonderful real estate podcast ever. Our motto, again, is stacking gold bricks in 26. So whether you get a gold brick, a nugget, whatever you get, it's going to be great. All of it together is going to help you become the best real estate investor possible. But I need you to like, subscribe, leave some 5-star reviews, and just help keep building the podcast. I do this for you so you can learn how to become a successful real estate investor. So let's stack some gold bricks in 26. Stay tuned and don't miss a single episode.